Today I have 7 multi-time frame trading strategies for you that you can use on any combination of time frames and on all markets. And the approach is as follows. We are looking for our trade idea on the higher time frame. We look for structures, levels, patterns on the higher time frame. We want to identify the momentum on the higher time frame. And once all of that aligns, we are going to a lower time frame to time the trade into the direction of the higher time frame. Let's start with the first one, a supply and demand zone pullback. So when we look at the higher time frame here, in this case it's the 4-hour higher time frame. You can also use the daily, the weekly. You can even use something like the 1 hour as your higher time frame if you're more of an intraday, very short-term trader. But what we are looking for here is the trend structure. We can clearly see that the market has been rising, so we are in an uptrend. And then on the uptrend, we want to look for structures. Here we first can see a fair value gap that has been created. A fair value gap you can usually find in those large candles where the previous and the last candle do not overlap. So it's this empty space. And underneath the fair value gap, we find the demand area. The demand area is the origin of explosive price moves. And once we have identified them, we are waiting for the price to get back to them. So shortly after we see that the price is hitting the midline of the fair value gap, I typically like to wait for the midline and not just the top area of the fair value gap. And when we see that the momentum is picking up into the trend direction that we are aiming for, remember we are in a bullish trend, we want to look for bullish momentum. Then we go to our lower time frame, and on the lower time frame, which is now the 1 hour, we find a head and shoulders, or in this case an inverse head and shoulders pattern. We can draw our neckline, we have the left shoulder, the head, the right shoulder. We already see that pre-breakout, the market showed this higher low here, and this is a pressure pattern. So the pressure was really building underneath the neckline. Then we have the breakout, and that's where you typically find your entries then. And you can see afterwards the market moved back into the previous highs here, and that would have been a very good place to take your profits. And you can see because we're trading with the higher time frame trend, the market really moves very nicely. We don't have a lot of opposition and the market generally just moves up. Shortly later, the market moves into the demand area. At that point here, I would say the fair value gap has been used and I would not use it anymore in my trading. I would wait for the price to touch the demand area. For demand area, what is very common is that you will see the price just touch briefly the demand area and then pushes higher. And then afterwards, you can see after the market has touched the demand area, the price moved higher, not too much, just a little bit. So you might not have gotten anything great out of it. And then the next signal is also very interesting. Here we get a fake out signal. The price, when it reached the demand area, put in the swing low, and then the market grabbed here below the swing low, taking out the low and also the demand area, and then shot up higher. This is a concept we call deceleration. I will come back to this in one of the later strategies in this video. And after deceleration, we see acceleration, and that's then where you find the next opportunity here. So at that point, after the deceleration and you see a strong market momentum come back into the market, that's where you go to the lower time frame and time the next trade. But I will show you in a moment how we find deceleration and acceleration trades. If you like this way of trading, make sure to check out my ultimate trading program. It's a trading course where I summarized my 16 years of trading experience into a few hours worth of video content. But there's so much more than just videos. You receive support from me 7 days a week. Every day, when you have a question, you can reach out, ask me questions, and I will respond to you 7 days a week. The trading program here consists of a trading course. There are over 80 new videos that I've never shared anywhere else before. The mentoring part is included. We have regular live webinars, and you will also be part of a lively community of traders from all around the world. I'm not using other teachers, I'm not using other mentors. You will be able to interact with me always directly. You learn my day trading strategies, my swing trading strategies, and you can apply to all the different time frames. Whether you are a completely new trader or you already have some experience, the course will help you make the step to the next level. The course in this program helps to build up your trading knowledge step by step. Here's a rough outline of the course, and as I said, there are over 80 brand new videos, so there's a lot for you to learn, and you will learn my actual trading strategies. I have dozens and dozens of trade examples for you. I show you how to backtest it. I give you my exact price action entry rules, and I'll show you exactly how to trade and how to prepare your charts. We also currently have a discount running, so make sure to check the link in the video description. And now let's get back to the video. Next, I want to show you how we trade patterns that we see on the higher time frame. And here we are looking at a head and shoulder trend continuation. So we're here on our daily time frame, and we can see that a head and shoulder is building. You will find head and shoulders patterns everywhere, but it really matters on where they are forming. And when we just look a little bit to the left, we can see that this is a major resistance swing point. So this is where the market turned from an uptrend to a downtrend previously. And that tells us there's a lot of interest in the market. And if we see that the market is failing to break above this again, and we're seeing this happening with a reversal pattern, the head and shoulders, this is a very meaningful clue. The interesting part about the head and shoulder is also the part where we go from the head to the right shoulder, because here we can see we are starting to make lower highs. That's really important market structure tells, because the market is not able to push higher anymore. Taken together with the failed breakout here at the resistance level, that's a really meaningful signal. We wait a little bit longer on the higher time frame, and we want to see that the market is breaking here the neckline on the higher time frame. Only then we will go to our lower time frame. A lot of traders make the mistake of going to a lower time frame before the neckline has been broken. But as we've seen in the past, the market is often struggling at this support level. So you want to see a confirmed close on the daily time frame before you jump to your lower time frame. Now we're on the lower time frame, and this is the neckline that we found on the higher time frame. The market has broken out, and a lot of traders have probably jumped onto the short trade now. And now let's just put us in the shoes of the short traders. If you're short, where is your stop loss? The stop loss is probably somewhere around here, maybe even above this swing point here. So we can call this our stop zone. And instead of shorting the initial breakout, what is a very interesting approach is to wait for the price to get back to the stop zone, and then we're looking for clues that the market is turning. So we want to see the market push into the zone, take out all the stops, and then reverse to the downside. So it's freeing up a lot of liquidity, and you can see as we hit the stop zone, the market is showing strong bearish candles. And when we pay close attention, what can we see here? It's another head and shoulder. So here we have the left shoulder, the head, and the right shoulder. The market is breaking the lower time frame neckline with strong force. So this is a very, very interesting pattern here that we see. It's a stop loss run with a head and shoulder, and a lot of bearish momentum is kicking in. So at that point, you have a much more reliable short signal that you can trade here. And afterwards, you can see the downtrend is really nicely unfolding. So we're trading with the higher time frame, we're trading from a higher time frame level, with a higher time frame pattern, with a higher time frame momentum, and on the lower time frame, we then time our entry to get the perfect reward to risk ratio. Now let's talk about deceleration reversals, and I think those are really fascinating candlestick patterns that you will find very, very often. So we are on the daily higher time frame, and I really encourage you to look for those deceleration signals on the higher time frame. And what makes a deceleration pattern great? First, it's very strong momentum into one trend direction. So here you can see we have very, very strong bullish momentum, and then it completely dies down. We have 3 dojis, almost perfect dojis, where we just have a wick and a flat body here in the center. And this shows us that the market is decelerating. So this means the market is slowing down. This is not good enough to short yet. We have seen similar things in the past, such as here we have a strong bullish move, then small bearish candles, but the market kept going higher. So we don't want to make the mistake of shorting just because we see deceleration. We want to see the market accelerate to the downside. Here we can see that the market is accelerating now. And now you have a few options. You can wait for 1 momentum acceleration candle or even 2. Because we are trading a reversal and we are very early on in a potential downtrend, you don't have to call the absolute top, because there's still going to be a lot of meat that we can grab here in the middle. So don't worry about missing anything. It's better to be safe than sorry, and it's usually better with reversal trades to wait 1 more candle. But we're going to a lower time frame now. We're going to the 1 hour, and here we see a great distribution pattern. So the 3 doji patterns we have seen on the higher time frame are here this sideways phase. We can see that for a long time the market didn't move, and then we finally have the breakout. So this is our acceleration candle that we've seen on the daily time frame. Again, we have our stop zone here. So the traders who sold now and who are now in a short position, where will they have their stop loss? Typically above the breakout area. Some traders may even have it here above the swing point, but generally somewhere in here is going to be the stops. And it's really helpful to always think, where will the traders have their stop loss? When you see a very obvious signal, it's always very good to ask yourself, where will traders have their stops? And based on that, you can often build very interesting trading ideas. So instead of shorting the initial breakout, we wait for the market to hit the stop zone. And very important is that we want to see acceleration into the trend direction. So we don't only want to see the market move into the stop zone, we want to see that the market is turning around with strong force. This shows us there's a lot of momentum coming into the market and the sellers are coming in. And at that point, it's even better to short because now we have a higher price compared to the initial entry breakout here. So at that point, you have a high reward to risk ratio, high probability trade signal. And you can see afterwards the market moved lower and the downtrend only really started after the market hit the stop zone and started to accelerate. So let's take a look at a continuation trade. So here we are on a higher time frame and we see that the market is in a bullish trend. In the bullish trend, the market established here the high, the market sold off a little bit, we have a low here, and then the market made a run to break the resistance here. What I found is that trading the initial breakout is often not as reliable because retests are very common. So generally what you want to do is you want to wait to see how the market is reacting. Ideally, you want to see that you have an inside day. So you want to have an inside candle after the breakout candle. An inside candle where the market doesn't move a lot or at least doesn't close very strongly against the breakout candle is a very good confirmation signal. The higher the candle close on the inside candle, the stronger the rejection signal. If the price on the inside day would have closed here very low, that would have been more of a bearish sign. But here we can see that the price is rejecting the level and then pushing higher here. So we're going to our lower time frame. We see that this is the breakout, this is the retest. And now all we do is we wait for the market to make a higher high. So at that point, we don't have to wait for a full day to close above the high. We just want to see a midday close above the high. We get that now here. There was already here a signal and you might have taken it and you might have been stopped out. It's totally fine. Nothing works 100%, but you get your second chance. And here at that point, you have your second entry. You can see the market moves higher, retest this area. We don't have a stop run. And afterwards, the market started to the upside. So even though the first entry might have caught you on the wrong foot and you might have needed to take a second entry, this still could have worked out very, very nicely for you. Let's take a look at another level trade. So here on the higher time frame, we can see that this is a major resistance level. The price is in a very, very long uptrend and then puts in this resistance area and then sells off for weeks and weeks. When you see such areas on your chart where long-term trends have started from, those are very meaningful signals. We want to see that the market is coming close to those levels. And this is a very, very tricky scenario. Very often you will see that the market is running into the level and then reversing. And a lot of traders who are looking at this level probably think that they have missed the boat and that they are now missing on the short trade because the market almost reached the level and then sold off. But I really encourage you to not jump on those types of trades and do not chase the market. This is often a very tempting scenario, but it's tricking traders to trade very bad signals. What you will often see is that the market is eventually pulled into the level, such as here. The market comes back and it's really pulled into the level. So this was a trap here and the market is back at the level, takes out the highs, and you can very easily avoid those kinds of signals. Don't chase the market down, wait for the level to be fully tested. If the market doesn't test the level, which sometimes it might not and it will run without you, so be it. But you can greatly improve your chances of finding a good trade by just waiting for the level to be hit. Those are much more high probability setups. Here we then see acceleration come into the market and now it looks really different. The market has taken out the level and we see acceleration to the downside. At that point we go to the lower time frame. The lower time frame gives us this good range. We can wait for the range breakout and afterwards the market sold off. And everything started from looking at the higher time frame level. Looking at those major higher time frame levels, especially the ones where long-term trends have started from and big market turnarounds have happened, those are really, really important levels that you always need to mark on your charts. So let's take a look at failed continuations. What we see is the market in an uptrend and the market is making a breakout here above the highs. However, just shortly after, the market shows us a very strong acceleration candle to the downside. This is very different from the breakout that we have seen previously. The previous breakout, we have seen a breakout candle and then an inside day. The inside day was able to stay above the resistance level, remember? In this case, the breakout happened and immediately the market falls lower. And this is a sign of weakness, especially when we look here at a trend that has already exceeded its Elliott wave count. I'm pretty sure if you draw a Fibonacci here, you will also see that the market has fulfilled its Fibonacci target. So there's not much more room here to go. The market has fulfilled its upside potential. We go to the lower time frame and here we see this V-top. The V-top is created by the strong breakout and the immediate reversal on the higher time frame. We see a fair value gap, we see the resistance here, we have a support level here. So there are a few things that we can work with. The market doesn't make it into the fair value gap, so we cannot use that. But the market breaks below the swing point here. Again, we don't want to take the initial breakout. And the market comes back to retest here this area. This could have been a stop run, and stop runs are generally a very good place to get in. And then you can see this was the stop run we talked about. The market moved lower into the next area, broke lower, retests, gives us another stop run, accelerates to the downside and starts lower. So those breaks and retests of the stop run areas are really common, and especially on reversal trends that are just getting going, you will often be able to observe them. So sometimes you will miss the top signal and the first signal. That's totally fine. Don't chase the market. Wait for the next confirmed signal that fulfills all of your criteria.